Hello everyone and welcome back to my video blog. As promised last time, I will share with you some of the trick of the trade, how to locate a good investment property and identify that is a good property for you to spend time to analyze it and invest on it. Okay, so I'm going to share with you first some of the definition of some terms that I use by the real estate investment broker. Okay, so the first term that used a lot is the cap rate or capitalization rate, which is taking the net operating income over the purchase price, the value, or the sale price. Okay, so net operating income is defined as your gross income minus the vacancy, minus property tax, insurance, management fees, utilities that you have to pay, and some maintenance fees, any type of fees before the mortgage debt payment. Okay, so the cap rate NOI is pretty much like the EBITDA on some of the financial report from a company. Okay, so it's the earning before interest, tax, depreciation, those kind of things, EBITDA. Okay, so the cap rate, and the second one we talk about the cash flow on the investment term they call cash on cash. Okay, so pretty much how much that generate the cash generated from your investment. Your investment is the cash, the down payment is cash. So how much cash you can get, that one is called cash on cash, which is pretty much the net operating income minus your debt payment, the PI, okay, the principal interest that you pay the bank, and after that is your cash flow. So it's your cash on cash. And the last one is the return on investment. Pretty much, every year you pay back 1.5% of your principal, you add on to your equity. So that's the return on investment, right? Okay. I'm going to give you, as a promise, a little bit trick how to identify a good property to purchase. I'll give you an example. If a property is selling or have a value of 500,000 and is generating $5,000 in monthly income, the 1% rule, okay, that is a super good investment to look into. Okay, so if it's a 1% of the value purchase price, you jump a bit, okay, to do an analysis, spend your time it, and then lock in the deal. The reason why is that one. So if you have a 1%er, you have 8% in cap rate, 12% in cash flow, and then 16% on return in investment. So that is a great deal. And if in California, Southern California, kind of hard to find this kind of thing. And what will be something that you should consider? Well, if it's an 80% of that one. So for example, the 500,000, instead of having $5,000, they have $4,000. It's still a great deal because what happened. A lot of places have no rent control, like Los Angeles, Santa Monica, okay, or Oakland up in Northern California. So you can improve your property and raise the rent. Okay, so to achieve what you have to be. But even at 80% of what I'm talking about, instead of the 1%er is a 0.8%. You still have 6.2 cap rate, 5% cash flow, and then 8.9 return on investment. And that those number is based on current rate of 5%. So it's not unrealistic. Okay, so the pointer for you to start looking for something is a 1%. It's hard to find. However, if I find a 0.8 percenter, it's great. Start looking, let's start work on it, and then I can help you to restructure, the whole thing to get you toward the 1%er. Okay, so I hope you enjoyed my little bit, tidbits about how to identify a good investment. And until next time, stay safe, stay happy. And next time, I will have asked you how to find something for seller carry. Okay, so I think that's somebody that's my series to bring you to become an investor millionaire in the Southern California rental market. Thank you.